the $50,000 misclassification penalty the IRS just issued. A cleaning company owner called me a couple of months ago. She was shaking. She'd just received a notice from the IRS reclassifying all 12 of her workers from independent contractors to employees, retroactively for 2 full years. The IRS wanted back payroll taxes, penalties, and interest, totaling over $50,000. She said, but they're not employees. They use their own supplies. They set their own schedules. The IRS disagreed. I'm Bev from bookkeepingcoach.net. In 30 years of bookkeeping, worker misclassification is one of the most expensive mistakes I see, and one of the most common. With 1099 season just wrapping up, the IRS is actively reviewing filings right now. Businesses that issued 1099s when they should have issued W-2s are sitting on a time bomb. Let me show you what happens when that time bomb goes off. Let me walk you through exactly what happened with this cleaning company, because this is one of those situations where the business owner truly believed she was doing it right. She wasn't trying to cheat anyone. She just didn't understand the rules. She'd been running her residential cleaning business for about 5 years. She'd built it up to about $780,000 in annual revenue. She had 12 people on her team cleaning houses across 3 counties. Business was booming. She was adding new clients every month. From day one, she classified everyone as an independent contractor. She'd give them a 1099 at the end of the year, no payroll taxes withheld, no workers' comp insurance, no unemployment insurance, no benefits. She paid them a flat rate per house cleaned and figured that made them contractors. And honestly, she set it up this way because that's how the company she used to work for had done it. She figured it was just standard in the cleaning industry. A lot of business owners in her industry do it this way. But that doesn't make it legal. Here's what triggered the audit. One of her workers got injured on the job. She slipped on a wet floor and she hurt her back. She went to the emergency room. When she tried to file a workers' comp claim, there was no workers' comp policy because the cleaning company wasn't carrying one, because the workers were classified as contractors. So the injured worker then filed for unemployment benefits instead. The state unemployment office looked at the claim, looked at the working arrangement, and determined that the person was actually an employee, not a contractor. The state then notified the IRS, and that's when everything unraveled. The IRS sent an auditor who looked at the working relationship between the cleaning company and all 12 of the workers using what's called the common law test. This test looks at 3 main categories: behavioral control, financial control, and the type of relationship. Behavioral control means, does the business control how the work is done? In her case, yes, she provided the cleaning checklist. She told workers which houses to clean and when. She did quality inspections. She required them to wear a company shirt. The workers couldn't send a substitute without her prior approval. That's behavioral control. That looks like an employee. Financial control means, does the business control the financial aspects of the work? She set the pay rate. Workers couldn't negotiate a higher rate per house. They couldn't work for competing cleaning companies. She provided the cleaning equipment for larger jobs. They didn't advertise their own cleaning businesses. That's financial control. That also looks like an employee. Type of relationship means, are there written contracts, benefits, permanency, and is the work a key aspect of the business? There were no written contracts. The workers had been with her for years, some since she started. Cleaning houses was the entire purpose of her business, not some side function. Every one of those factors points to employee. The IRS auditor concluded that all 12 workers should have been classified as employees for the entire time that they had worked for her. The auditor assessed the reclassification going back 2 full tax years. Now, here's where the math gets devastating. Over those 2 years, she paid her 12 workers a combined total of approximately $468,000. As the employer, she should have been withholding and paying the employer's share of FICA taxes. That's Social Security and Medicare at 7.65%. Her share of FICA on $468,000 is $35,802. But the IRS also said she should have been withholding income tax from their paychecks. Since she did it, the IRS used a formula to estimate what should have been withheld. The estimated federal income tax withholding came to $46,800. Now, the IRS has a provision called Section 3509 that reduces the employer's liability when the misclassification wasn't intentional. Under Section 3509, instead of owing the full withholding amount, she owed 1.5% of the wages for income tax withholding. That's $7,020 plus 20% of the employee's share of FICA, which is another $3,580. So with the Section 3509 reduced rates, her federal tax liability was $35,802 for employer FICA, plus $7,020 for income tax, plus $3,580 for employee FICA. That's $46,402 in back taxes. Then the IRS added a failure to pay penalty for not filing the quarterly payroll tax returns she should have been filing. That added $2,320, plus interest on the unpaid taxes going back 2 years, another $4,180. Federal total, $52,902. But we're not done. The state also reclassified the workers. The state wanted back state unemployment insurance taxes for 2 years. In her state, the new employer SUTA rate was 2.7% on the first $9,500 of wages per employee. For 12 employees over 2 years, that came to $6,156, plus state penalties and interest of $1,840. And remember that injured worker? Because there was no workers' comp insurance, the state labor department fined the business $12,000 for operating without the required coverage. The injured worker also filed a civil claim for her medical bills, which the cleaning company had to settle for $8,500. The total damage? $52,902 in federal back taxes, penalties, and interest, $7,996 in state unemployment taxes, penalties, and interest, $12,000 in workers' comp fine, $8,500 injury settlement, grand total over $81,000. For a business doing $780,000 in revenue on thin margins, that's a catastrophic hit. She had to take out a loan to cover it, which she's still paying off. And here's what I haven't even mentioned yet. Going forward, she now has to run proper payroll for all 12 workers. That means employer FICA taxes of about $27,000 a year, state unemployment taxes of about $3,000 per year, workers' comp insurance about $9,500 per year, payroll processing costs of about $3,600 per year. Her annual labor costs went up $43,000 overnight. Overnight! Because the costs she'd been avoiding for 5 years finally caught up with her. The most frustrating part, if she'd just set this up correctly from day one, she could have priced her services to cover these costs. Her clients would have paid slightly more, and the business would have operated on proper margins. Instead, she built her entire pricing model on illegally low labor costs, and now she's scrambling to raise prices without losing her clients. So let's talk about what actually makes someone an employee versus an independent contractor, because this is one of the most misunderstood areas in business. The IRS doesn't care what you call someone. You can write independent contractor at the top of your agreement in big, bold letters. If the working relationship looks like employment, the IRS will treat it as employment. A piece of paper doesn't override reality. Here are a few key factors that the IRS looks at. First, behavioral control. Do you tell the worker when to work, where to work, and how to do the work? Do you provide training? Do you require them to follow specific processes or procedures? The more control you have over how the work gets done, the more it looks like employment. A true independent contractor decides how to accomplish the work. You give them the desired result, and they figure out how to get there using their own methods, their own tools, their own judgment. Second, financial control. Do you set the pay rate, or does the contractor quote you a price? Can the worker make a profit or suffer a loss on the job? Or do they just get paid a set amount regardless? Does the worker have significant investment in their own equipment and tools? Does the worker offer services to the general public, or do they only work for you? Can the worker work for your competitors? A true independent contractor has the ability to profit or lose money on a job, has their own significant business investment markets their services to multiple clients, and isn't financially dependent on one company. Third, the type of relationship. If the work being performed is a key activity to your business, a software company hiring a software developer, that's your core business activity, and that worker is probably an employee. That same software company hiring a plumber to fix a bathroom, that's not a core business activity, and that worker is likely a true contractor. Also, is the relationship permanent or ongoing? Or is it for a specific project with a defined end? Ongoing, indefinite relationships look like employment. Project-based work with a clear completion point looks more like contracting. Here are the red flags I see most often when I review a business worker's classifications. Workers who only work for you and nobody else. Workers who work set hours that you determine. Workers who use your equipment and materials. Workers who can't hire their own helpers or substitutes without your approval. Workers who've been with you for years with no defined project end date. Workers who you train on how to do the job. Workers who can't take on competing work. If 3 or more of those red flags apply to any of your workers, you may have a misclassification issue. And here's what business owners don't realize about the risk right now. The IRS just received all the 1099 NEC forms filed for last year. They're cross-referencing those 1099s against other data, unemployment claims, workers' comp claims, industry audit patterns. If you filed 1099s for a dozen people in an industry where employees are the norm, that's a red flag. If any of your workers filed for unemployment or got injured on the job, that's a flag. If you were audited for anything else and the IRS noticed contractor payments, that's a flag. The IRS collected over $7 billion in employment tax assessments from misclassification cases in recent years. This is a major enforcement priority. They are actively looking for this. So what are your options if you're using contractors and you're not sure you're classifying them correctly? Option 1, assume you're fine and do nothing. This works until it doesn't. When it doesn't work, the minimum cost is tens of thousands of dollars. As you just heard, it can easily be over $80,000. And you don't get a warning, you get a bill. Option 2, try to evaluate the classifications yourself. The IRS has Form SS-8, which you can file to request a formal determination. Be careful with this, though. You're essentially asking the IRS to investigate your own working relationships, and you might not like the answer you get. Option 3, have someone who understands worker classification review your current setup and identify where your risks are before the IRS does it for you. Know whether your contractors would survive IRS scrutiny. Fix what needs to be fixed on your teams, not the IRS's terms. The worst option is knowing you might have a problem and waiting for the IRS to be the one who tells you. Because by then, they're not just telling you, they're billing you. If this video has you second guessing how you've classified your workers, you're probably right to be concerned. And the good news is, this is fixable, but only if you address it before the IRS comes knocking. At bookkeepingcoach.net, We have courses designed specifically for small business owners who need to understand the financial and compliance side of running a business. Worker classification, payroll, QuickBooks setup, tax readiness, all the things that protect your business from exactly the kind of nightmare I just described. 30 years of experience, real-world situations, practical training you can actually use. Head over to bookkeepingcoach.net and find the right course for your business. The link is in the description below. And if you issued 1099s this year and even one of those workers has red flags I just mentioned, don't wait on this. The IRS is reviewing those filings right now. Calling someone an independent contractor does not make them one. Writing it in a contract doesn't make it true. The IRS looks at the reality of the working relationship, and if it walks like an employee and quacks like an employee, you're paying employee taxes, plus penalties and interest, for every year you got it wrong. Getting it right costs a little more upfront in payroll taxes and insurance. Getting it wrong costs 5 to 10 times that in back taxes, penalties, fines, and legal fees. The math is simple. The choice should be too. Subscribe to the channel for more QuickBooks and business compliance tips. Head on over to bookkeepingcoach.net. The link is in the description. And make sure your business is set up the right way. I'll see you in the next video.